Number one, declare full income on investment and rental properties, okay? So it's most likely your rental income has dropped either because you had no tenants or your tenants negotiated a lower rent during the pandemic period. So you got to make sure you get the right figure and declare it correctly. Now, number two, avoid mates rates. So investors can claim deductions for the period that the property is genuinely available for rent or has been rented. Now, this means you cannot charge mate rates rather than the market value or rent part of the year and then claim the full year. You can't do that. You can only claim for the period that the property has been rented.
Now, I'm surprised you even know what that word mates rates means, because whenever I've asked you to help me out, you always say, mate, there's no friendship in business and you're constantly wanting to charge me full freight. So I'm glad you managed to get that out of your mouth, Ben, and I'm going to remind you of that next time I ask.
I knew I was going to regret this. Yeah. Now, for an example, if the property is rented to a friend or family member for discounted rate, this cannot be included because this is regarded as a non-commercial rental. The income is still taxable, but you can only claim deductions up to the annual rent you have received. You also cannot claim a loss, which is not the outcome you want if you're claiming on negative gearing. Number three, do not claim deductions on newly purchased properties. As Gregory correctly sort of pointed out earlier, that we had $9 billion worth of investment loans. This is the highest it's ever been since June 2015. You cannot claim deductions right away. Costs for repair, damage, and defects are deductible over a number of years or added to the cost of the base of the property for capital gains tax purposes. You should wait 12 months before making these kind of claims. Number four, don't use your redraw facilities on investment mortgages for personal use. I've been guilty of that in the past. This facility is made possible that allows drawback for additional payments made on the loan. So for an example, you cannot use a redraw facility to purchase a new car. That's me.
What about
I've done in the past. No, an ATO would be looking into this. Trust me, I know. Now, avoid incorrectly apportioning the rental income. So when there's more than one owner in the investment property, you have to divide expenses equally and not choose the one of the two people that has a high taxable income and let them claim more. That's not allowed either. Now, avoid claims for properties not generally available for rent. For an example, if you're on a holiday home that you don't rent out and don't claim anything relating to that property in your tax returns until you sell it. Okay, ATO are keeping an eye out on properties that are not advertised on a widely seen online site, properties that are poorly maintained, homes for rent but unreasonable conditions. For example, no children allowed. You know, properties to put it more plainly, properties that turn away reasonable tenants. Okay. Now, number 7, we're coming to an end. I know I'm taking a while.
Sorry, Lucas, can I just interject there? And I think, you know, we always talk about how important it is to partner with experts in the field. And, you know, that point that Lucas just talked about there, nothing could be more important than getting the right property manager. Because one of the things that the ATO have a huge amount of staff being able to do all this digital, you know, data mining, as we talked about on the key sites. But those of you that aren't aware, the legislation has just changed in Victoria a couple of months ago. And one of those key changes is that every 2 years, you need to get an electrical and gas certification. So I'm imagining, Lucas, that's where, you know, in the next 2 years, you know, the ATO is going to be able to jump out and say, hang on a second, was this really available for rent? Because you didn't comply with the relevant state legislation in terms of having those certificates. So that's probably one where definitely you need to get that right advice and have the right property manager to make sure that you are set up and key for that, wouldn't it be?
My next one is, it's a very big one actually, and will apply to a lot of people. And that is, remember to claim their home office. Now, ATO said people that claim to be working from home last year jumped by more than a third to 4.42 million. Now, this is a little bit complicated because there's 3 ways of calculating this. Now, the shortcut method is 80 cents per hour, which includes phone, internet, gas for heating, cooling, lighting, and equipment. If you choose to claim this, you don't need a dedicated work area, but you must keep a diary of the hours you work from home. Now, number 2 is the fixed rate, which comes out to 52 cents per hour. This is for those with a dedicated workspace or a home office. This doesn't include electricity, phone, internet. So, you know, and the internet, you have to claim for the hours you work, not the hours you're watching Netflix.
I was going to say, what about Spotify, Netflix, Stan? Right now, you know, my kids are smashing the internet watching the Olympics. You know, with that. So you're telling me I can't claim all that overage I'm getting for all the downloads they're doing on the Olympics?
Sorry to tell you this. Now, the other one is the actual cost method, which means you use all your expenses to work out your deductions for your work, anything from cleaning to computers. Now, this is another huge one, depreciation. Depreciation, for those that are not familiar with the term, depreciation is the natural wear and tear of property and assets over time. It is actually the second largest tax deduction after their loan interest. So always make sure you claim on that. Now, number 2, it's a good tip, very important tip. Be careful with records. Keep accurate records for income and expenses. Information must not be changed or damaged. Must be in English, and if it's not in English, has to be translated. And a very good idea is to take photo of receipts to protect from loss or damage. And number 10, don't claim expenses for visiting rental properties. In the past, we were able to do, now we cannot. So you cannot claim the cost for travel when inspecting your rental property, or if you're going to carry out some repairs.
So we can't own a Gold Coast property and put our entire holiday trip up to the Gold Coast for a week has been deductible anymore.
We used to, but not anymore. Things have changed, and this is very important. And this is why I try to sort of cut it short. But it's so important for everybody to be up to date with all the latest rules and regulations, because you don't want to be stung by the ATO.
All right, look, that was really, really informative. I hope that most of you, were able to take note of those. I will put it up on the socials and YouTube after. So if you missed anything, you can go back, because I think, Lucas gave you a ton of information there. Some of them will be relevant for you, some won't. But I think it's always good to make sure you're on top of these, because, you don't want to perhaps make decisions or, find that it's too late. Looking back historically, you might have made a different decision. So really useful, and I do appreciate that.